Good morning everyone and welcome to another hour of crypto video. Well, in the last 24 hours, the markets have moved quite laterally. Bitcoin is only up by 0.36%. Ethereum did quite well, it's up by almost 2%. However, in the last 7 days, we saw that the markets erased all those gains that it had made in the previous 3 to 4 weeks. Remember that the price of Bitcoin, for example, was 18,000 and the crypto global market cap was at about 850 billion. But there was a mini bull run and a mini rally which saw the price of Bitcoin going up to almost 24,000 and the global crypto market cap going to above 1.1 trillion. However, in the last 7 days, if you can see here, Bitcoin is down by 10%, Ethereum by 8%, and the global crypto market cap is now down below the $1 trillion level. The rest of the market is looking green, but these movements could be seen as more lateral because they're small numbers, 1 to 2%. However, in the last 7 days, you can see that the numbers are a lot larger in the negative scale, down by 11, 12, 19, 12, 15, 14%. So all those gains that have been made have been erased. All the hard work by the bulls have quickly been erased by the bears. So it took 3 weeks for the bulls to push the prices up, and it only took a week for it to go down again. Looking at the Bitcoin charts, we see here that it's trading between the $20,000 support level and the $22,000 resistance level. And it is moving laterally, like I said before. We aren't seeing any sudden and rapid movement toward either the resistance or support levels. It is trading sideways. What I mean by sudden movements is, for example, here, we see that it was trading at the $22,000 support level, and then there was a sudden movement and massive green candle which saw it shoot above the $23,000 level. That's not happening right now. The markets are consolidating. They're basically getting together their information in order to see what the next best move is. They're seeing what the risk levels are. They're probably getting the information from the markets to see whether the negative news outweigh the positive news or vice versa, in order to decide whether to jump back into crypto or remain in stocks and bonds and commodities like gold. Because remember, when we hit the bear market, a lot of billions or even trillions left the crypto market, which is a risky asset, and went into the stock markets and the bond markets, which are safer assets. And people are still holding on to their money in those safer assets, waiting for this sort of socio-political, geopolitical, and socioeconomic risks in the world at the moment to die down a little bit, so that they can pump money back into the riskier assets, because they won't pump money into risky assets in difficult times. Risky assets only make money during safe and conducive times when economic growth is strong, which isn't the case at the moment, especially due to conflicts in the world, rising inflation, and food shortages, and the explosion of the price of oil. So over a quarter of Asia Pacific's emerging giant startups are tied to blockchain. A report from KPMG and HSBC, based on a survey of almost 6,500 Asia Pacific startups, found that over 25% of them are blockchain related. NFTs led the way among the sectors where Asia Pacific emerging giants were active, followed by DeFi. So other traditional companies include electric vehicle charging infrastructure, quantum computing, and robot process automation. So this is all part of the electronization or computerization of the economy, and blockchain plays a very big part of it. However, despite the strong collective presence, blockchain-related companies were most common in the lower ranks. Among the top 100 emerging giants, only 5 were blockchain-related, and this makes sense because blockchain is still a very, very new technology. There isn't much regulation surrounding it, and there's still quite a bit of uncertainty relating to what their uses can be, and it's a matter of trial and error to see where best in the economy blockchain can be implemented. So at the moment, obviously not a lot of companies will be in the top 100 emerging giants, but having 5% of those emerging giants being blockchain related is already a very good sign, especially it being such a new technology. So here it says that the continuing growth of Asia's middle classes, and especially the emergence of Gen Z consumers, will be the biggest single factor driving digital economies across the region. And it makes sense because Gen Z consumers want to become more digitized, they want to be more connected to alternative forms of finance, more technological advancement, and it just makes sense for them to want to adopt blockchain and, in essence, cryptocurrencies. So a lot of Asians, especially millennials and Gen Z, moving into the middle classes will lead to adoption or even faster adoption of these technologies. So a bipartisan bill in the United States seeks to eliminate taxes on crypto transactions under $50. So at the moment, IRS regulations state that even when the smallest of crypto transactions amount to capital gains. So when you sell a virtual currency, you must recognize any capital gain or loss on the sale, subject to any limitation on the deductibility of capital losses. So any single sale of crypto transactions you have to record and report to the IRS, which is a major inconvenience if you just want to buy a cup of coffee. Let's say you bought Bitcoin when the price was 21,000 and you sold it when it was 21,200, but you sold it to buy a cup of coffee. You still have to declare that to the IRS, which doesn't make sense. So a bill was introduced in the Senate today that would prevent Americans from needing to disclose capital gains or losses on most smaller scale crypto transactions. And this would be transactions less than $50 or trades in which a person earns less than $50. So there are similar bills that are working their way through Congress, and there is another bill that says crypto gains of less than $200 shouldn't be reported to the IRS. And these kind of bills are becoming more common because it says that while digital currencies have the potential to become an ordinary part of American everyday lives, our current tax code stands in the way. And this type of bill would help Americans use crypto more easily as an everyday method of payment by exempting from small taxes, personal small transactions like buying a cup of coffee. And it makes sense because why would you go and buy a cup of coffee using crypto if you need to declare that transaction to the IRS? It's just such a hassle and inconvenience. You might as well just use cash. As previously mentioned, antiquated regulations that are more suited to traditional finance, do not take into account the potential use of virtual currency in our daily lives, instead treating it more like a stock or an EFT. And the potential for it to be a currency is being debated heavily in Senate and Congress, and this is why these bills are being proposed. And this is a very good sign, because if small amounts like $50 or $200 are exempt from capital gains, there will be a lot more adoption of cryptocurrency, especially for the payment of goods and services. The IMF says that Bitcoin crash hasn't harmed global financial stability. So they acknowledge that the crypto market has experienced a dramatic sell-off, but added that it still hasn't hurt the financial system. And as investors face uncertainty with the Eastern European conflict and supply chain issues, among other macroeconomic factors, they're shifting risky assets. And what they mean by this is that there's been a dramatic sell-off of crypto assets, and a lot of crypto investment has flowed out, and that investment has gone into stocks and bonds and commodities like gold that retain its value better and they're less risky than crypto. And this sell-off, which amounted to trillions of dollars, spilled over to the global financial system, but their effects have been limited so far, which is a good sign, meaning that despite there being some connection between the crypto world and the traditional finance world, contagion was limited. And there has been a lot of push for regulation to prevent such issues in crypto from happening again. As crypto becomes more and more ingrained with the traditional finance world, we will see if there is a crash similar to what happened now in the future, when crypto and traditional finance are more merged, then the spillover will be great and it will be felt by the traditional finance stocks, equities, bonds and such. So in order to avoid this, there has been push from institutions like the Bank of England and Federal Reserve to push for more regulation of crypto, especially stable coins, which are used as a currency. And this makes sense, and it's a good sign, because if there's regulation, there will be less chance for them to fail, due to the fact that they will have to have securities in place to ensure that the stable coins are backed properly. And they're saying this because this crash was partially caused by Terra's stablecoin UST losing its peg to the dollar, as it didn't have enough reserves to maintain the peg. And many investors were burned, and the contagion from the Terra fallout spread to other segments of the crypto market as well. So in order to prevent this, we need more regulation. And if we have more regulation, there will be a lot more adoption, because the stablecoin operators, and by extent, the crypto market operators in general, will know how to operate in the market by law. and within the framework. And with that, we come to the end of today's video. Thank you very much for watching. If you enjoyed the video, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely, and cheers.